Welcome to the Game of Investing podcast. This is Sandeep, Anand. In today's episode, I'm going to talk about a topic which is very interesting for aspiring investors or entrepreneurs or businessmen for that matter. Whether you're going to invest in public or private markets, this is a very important framework that you need to carry along with you. You can call it a mental model. Now, this is like a simple 4-step framework which you can apply as an investor or as a businessman. What are those frameworks? What are those steps involved? There are 4 traits that you need to look for while evaluating a business that has the potential to grow. The number one trait I would say is, what is the problem that the business is trying to solve? If the problem business is trying to solve is so large in terms of addressable market, what you call that is the TAM, that is total addressable market. If the total addressable market is a large market that the business is trying to solve the problem into, then you have kind of found the right spot. Now, it's just not sufficient that the business is trying to solve a problem which is sufficiently large addressable market, but it's also necessary, it's also important that the runway is long enough. What do I mean by runway is long enough? That the TAM, the addressable market, is so large that the business can keep solving this problem to millions and billions of people over a long period of time. That the business can grow into the large TAM, and that gives a runway. Like for example, I'm going to bring a case study here for each of the trait so that you can understand and map on how to solve that problem, right? So when it comes to problem solving, let's take the case study of Nubank. Nubank is the largest digital bank in the world. This was started just around 11 years back. In 2013, Brazil and Latin America, the whole of Latin America, has around 650 million people in population, and 50% of that population is unbanked or underbanked. They don't have, the 50% is unbanked and the remaining 50% is underbanked. What do I mean? These people don't even have a bank account. 50% is 1 in every 2 people do not have a bank account. And for those who has a bank account, goes through a very stringent physical, laborsome, cumbersome process to open a bank account, and they don't get all the features. Just to avail a credit, just to get a loan, they have to pay, sky high valuations in terms of interest rates. They have to pay 300% interest on credit cards, and it's insane kind of a situation that existed in 2013. Now, David Wallace, who is the CEO of Nubank, in 2014, he moved to Brazil. He went to open a bank account. He was made to wait almost an hour in the Brazil, one of the banks in Brazil, and then he has to fill physically a lot of papers. Come back home. He was asked to come back again to the bank like 5, 6, 7 times within a span of 6 months, and finally his account was opened and many other features were enabled. Now, take this in 2013-14, and even still today, 6 to 7 banks roughly controls the 95% of the banking and financial needs for Latin America, and specifically for Brazil. Brazil is the largest economy. So David Wallace found that there is a significant problem out there in Latin America, and he has to solve this problem. And he was tired himself, so he decided to solve this problem. And that is the addressable market he found. So Nubank was born there in 2014. They launched with a co-branded MasterCard in somewhere in 2016, kept adding one by one and started solving the problems. How did he solve the problem? So now he wanted to solve the problem that people should not go to the bank physically. They don't have to fill out a lot of papers. They should get avail to the credit pretty easy, just in a swipe of a mobile. So he started a digital banking mobile app, and he made a completely digital bank with very negligible presence of physical stores or physical banks or branches. That was so easy for people to just click, get a bank account open. And this was a large addressable market because entire Latin America is out there as a market. And look at the runway to grow. Even today, Nubank has roughly 20% of the market share in terms of addressing the financial needs. And that's still a long runway to grow. So this is first trait. Now, let's understand the number 2 trait, which is like, what is the value creation? It's just not enough that the business is trying to solve a problem, but how much value is the business adding? And when you look at Nubank, they started with a digital bank, which is a significant value in itself. It was a leap forward, right? Because first of all, people are not even getting access to banks, and now new bank is given a choice to customers to open a bank account from home by just filling in some information. And just not that, what are the value that new bank added? They kept adding features after features. The customers can avail credit, they can get loans, they can just know their credit history, and they can cross transact. They could transfer P2P, that is person to person transaction. It was so much that people had to literally go and do a money order transfer for just transferring few dollars, Brazilian reals, to people. So it was so difficult for people to just do even a transaction or bank account transaction, pay their credit bills, pay their bills, and all of that. So Nubank kept adding features, and to such an extent that even people can invest in crypto via Nubank app. So it was a optionality that Nubank kept adding value to the customers. With just one account, they could cross-pollinate, they could use multiple features within that account, including investing and including availing loans. So Nubank kept adding value, and that is one other important trait that we need to look at businesses. It's just not solving problems that millions of people have. It is also how much value they are adding, because otherwise your competition can come and eat away the market share. Now look at this. So as I said, how long is the runway? The runway is pretty big. If you say the top 10 banks in Brazil occupies 90% of the market share, and they are roughly valued at $250 billion market capitalization, put together all the banks, right, across Latin America, including Colombia, Argentina, etc., and Mexico. So if you add up all of that, roughly around $250-300 billion is addressable market cap that the banks have taken away, and new bank is just trading at $45-50 billion today. So it is a roughly 5x runway that we can look at for new bank. Now that is one factor. So we covered number one, number two. That is, what is the addressable market and what is the value that the business is addressing or providing to the customers. The third most important thing is the operational efficiency. So it's just not enough if you are giving value, because many businesses out there are throwing money. That is the cash they're generating, or the investors are putting into these businesses. They're just throwing the cash at providing, customers in the name of value, just burning cash. That's not the right way to do it. Nubank, from the day one, their target was to be profitable. So they were growing above 100%, but at the same time being profitable. Their focus was so stringent on the operational efficiencies and capital efficiencies. They were growing profitable from the first initial few years itself. And you can look at the numbers. So what I always say is, most investors, they start with the numbers. They look at what's the growth rate, what is the return on invested capital, etc., what is the margin and all. See, I would say this way. The only takeaway from this podcast should be this: the numbers speak for itself. Numbers are just an outcome of the three traits, that is the value addition, addressable market, and efficiencies, operational as well as capital efficiencies. Numbers is just an outcome. Financial metrics are just outcome. Don't get bogged down by the numbers. So as long as the management has a focus on the efficiencies, the numbers will speak for itself. You look at the growth, right? The numbers are what I'm talking about is Nubank has grown to 114 million customers just through the sheer word of mouth, and that's happened over the last 8 to 10 years span. It was an exponential growth, because that's the addressable market and that's the value Nubank kept adding, right? And that growth is right now in such a way that 1 out of 2 Brazilian adult population is a Nubank customer. Now they have penetrated into Mexico, Colombia, and immensely successful there as well. They have seen explosive growth there, right? And they have acquired almost 15-20% market share by just their service. So David Wallace is the greatest leader out there, visionary leader, and that speaks, right? You need a management who has vested interest to achieve that kind of value addition for the customers. They are obsessed, just like Jeff Bezos of Amazon. They're customer obsessed, and that speaks for the volume. Look at the return on equity. Return on equity for Nubank is at 28 to 30%. You need to be aware that when a bank okay, especially digital bank, is able to provide a value like a low cost service, which is low fees, absolutely low fees. When you compare to the banks that are charging fees out there, New Bank is able to provide low fees and low cost of operations. Their customer acquisition cost is very low. This is because they have completely voided all the requirement for the branches, physical branches, because it's a completely digital app. You don't need to have physical branches. They have established a model, which is another important point. Whenever you look for investing ideas, look for new business models or disruptors. Disruptors usually are the ones, or innovators. They're usually the innovators. They come up with a new product or new service or a new way of addressing the same space, completely new way of doing it. That was what New Bank did through their digital banking. And they are just starting, right? It's just in the scratch the surface. They have long runway ahead. Now look at the return on equity. It's 28%. For a bank to have a return on equity of 28%, it's a dream come true for any founder or investors for that matter. So that's what New Bank has achieved in the last 10 years. Now, finally, it's not the margins are speaking for itself, and the efficiencies and the profitability, correct? So the numbers are an outcome of these three traits, right? And finally, as Charlie Munger said, no matter how great the business is, there is a valuation you need to take into consideration. You cannot give sky high valuation for however good the business is. So how do you determine the valuation? There are two mental models I can explain. First one is, did I buy the fear? You need to look at buying businesses, however great they are, during fear conditions. Let me tell you, New Bank, because the business is so good, management is so good, it was given an extremely high valuation during the IPO in 2021. It started trading at a price to sales of 50 times sales and bleeding valuation of some 15 times book when it started in 2021. So no matter how great the business is, if the investor had invested in 2021, the returns till date is zero or negative. See, this is an important thing. Even though you have found a great business, you did not pay the right valuation and you suffer. How do you know the right valuation? It's a subjective term, it's a relative term. There are two mental models, as I said. The first one is, did I buy the fear? You look in the chart, how many times there has been dip. New Bank has dipped 70% in 2022, in 2023, two times, 70% drop. You could have bought then. The stock price came down all the way to $3 per share. And that was trading still at a price to sales of 9, which was still a valuation which was high in spite of a 70% dip. But then it again went back up because the growth kept on. Again, there was 30%, 40%. As recently, right now as we are talking, it is a 40% drawdown in April 2025. And so this could be is it a good time to buy? Well, the price to sale again is around 9 times. And the price to book, you need to look at the price to book because this is a bank, right? So I'm okay with a 3 times forward price to book, but currently it's trading at 7 times price to book. The average multiple of price to book has been skewed towards 6 times. So it's slightly above average, but still it's not expensive. If you give up 1 year of ahead earnings, next year earnings, or the book addition, value addition, then you're okay because you're looking at a 3 times forward, 2 years forward. So if you can get a runway of 10-year growth, but you're able to give up a year's earnings or value addition or growth, then you're okay buying New Bank today. Now, there is another mental model I would say. Look at the price to earnings, right? Can the price to earnings be like a single digit, like somewhere between 1 to 5 years from now? Which means you are paying up for the next 5 years earnings, and come 5 years, after 5 years, you're getting the business for free for the next future growth. Right? Can that happen? Yes. So that is an important mental model. So you look at 2024, the price is $12 today. The EPS is 0.4, that is earnings per share. A PE of 30, correct? Now earnings per share growth is year on year. Last year to this year, earnings has grown 100%. Now let's assume that it's not so rosy, the economic conditions are bad. Assume in 2025, the business growth slows down to 50%, which means your EPS tends to become 0.6 and your PE becomes 20. Keep doing this. The growth keeps slowing. At some stage in 2029, say the growth is 20% because the addressable market is 40% covered. or 30% covered, right? In that aspect, when the growth slows down to 20%, come 2029, that's 4 years, 5 years from now, approximately the PE would be 5 to 6 times. In 2029, it could be 6 times with the growth rate I've shown there, which means the EPS has grown to $2 per share and the stock price doesn't go anywhere. It just assume that it stays at $12 itself. Now, for a company that is growing at 20%, okay, and a PE of 5 or 6 in 2029, the price is per share is $12. Assume that typically price to earnings to growth PEG ratio is usually balancing towards the growth, rebalance or mean revert to the growth. So when there is a 20% growth ahead, then the market would tend to give a 20 to 25 times earnings, price to earnings growth, that is PE. So the PEG becomes approximately 1. 25 times growth PE and 20% growth, 25% growth, it's approximately 1. So what happens there is the PE ideally should be roughly around 20 to 25 at that point of time. Now, what is a PE? Based on our calculation, it is, if the stock price doesn't move, it is $5 to $6. $6 going back to $24 just based on the mean reversion or the multiple reverting based on the growth is a 4x returns in the next 4 years. Right now, I've assumed a lot of things here. As always, we have to go with certain assumptions in the futuristic growth. Anything could happen. There could be disruptors, there could be new competition, especially competition is growing. There is Mercado Libre's, Mercado Pago, which is taking away market share. Then there are other companies like StoneCo and many other banks, digital banks that Revolut, I think Revolut is taking away market share. There are many other companies that can come and take away market share. So let's assume a moderately slowing growth, like from 50 to 30 to 25 to 20, which is possible. So you're looking at a 4x, 5x returns approximately in the next 4 to 5 years. Now this could be a 3x, it could be a 7x. Doesn't matter as long as I'm okay with a 3x returns the next 5 years or 4x returns the next 5 years, which itself is 30 to 35% compounded annual growth rate. So this is how you look at a mental model. See if the PE will dilute to such an extent that it comes to a single digit PE like between 1 to 5. Look at the price to book the same way, or you can look at based on the earnings growth or based on the free cash flow growth. If it is a software company, look at the free cash flow because they are investing. They might not have earnings. So look at the free cash flow. Can it come to such an extent that the free cash flow in the next 5 years in price to free cash flow goes to a single digit? Now, this is a very good mental model if you can apply. And see the addressable market if they are continuing to grow, because Brazil is a young population fairly and the addressable market also grows. It is not that it's stuck at 600 million and it's stuck there. There is a growth of 5 to 6% of GDP wise as well. So which is important to understand. So putting it together, the efficiency, the addressable market, value addition, and I missed an important point when it comes to efficiency. The operational efficiency just shows, right? Cost to income ratio, for the example, in this new bank case, the cost to income ratio has reduced from all the way to 90% all the way to now 30%. It could come down to 20%. Imagine a bank having a cost to income ratio of 25-30%. What else can you ask for? So that is operational efficiency because they have the operating leverage. As the number of customers increased, as the number of services increased, as the other net income fees and other fees, non-net income fees increased, and they put stringent cost efficiency measures, your return on equity increased. At the same time, your cost to income ratio reduced, which is nothing but the total cost it takes to manage the business with respect to the income, right? So they are reducing the cost of operations, and by operating leverage they are increasing the margins, so which is all perfect. So this is how you look at the operational efficiency as well. So putting it together, to just conclude, look for businesses that addresses a large market. It could be a business. In the addressable market need not be like in billions. It could be a sector where the addressable market is just for 40 million people, but the company is only worth, say, less than $1 billion, right? Less than $100 million. But the addressable market is, say, $5 billion. It need not be 10 billion, 100 billion, $1 trillion. It could be as big as 100 million, $1 billion, but the company size is relatively small. So the size of the company or the business relative to the addressable market, that's how you look at it. Second, what is a value addition? How much value, how much customer obsessed the leadership is. Third, operational efficiencies, how well and capital efficiencies both put together, right? And finally, it is about the valuation. When do you buy that? Do you buy during the extreme fear conditions, or when there is generally fear conditions, when the market is mispricing the future growth? In this case, yes, the market is mispricing the future potential growth for new bank, right? So let me conclude there. Trust this was helpful. Signing off, Sandeep, Anand.